So what is short selling? Short selling is a trading action when you expect the price of a stock to fall. It all starts with you, a bright idea. You want to short a stock. Your broker can try to find the stock in his own inventory to see if someone will willing to lend to you. Or he can go to other brokers and ask if they can have the share to lend out. If broker B has the share to lend out, then broker B will go to his client and ask for the share. That stock then can be lent to you. After you receive the share, you can sell it at open market. The cash you receive from selling the stock will go back to broker B as a collateral. Any dividends that could occur during the holding period, and also the borrowed fee that was prearranged during the time that you borrowed, will have to go to the broker-dealer B, which then will distribute normally the dividends go back to the client, who is actually owning the stock. When you do decide to buy the stock back, hopefully at a lower price, you can buy it at open market. After you buy it back, that goes back to your broker, and that is swapped for the collateral that they have with broker B. Then the original owner gets his stock back, and hopefully you're ending up with a profit of the money that you got. So what could happen? Let's say in the case that the original owner wished to sell his stock also at the open market. So he goes back to his broker B and asks to sell his stock. Broker B could contact your broker indicating that he would like to recall his shares. Now your broker can do the following. Either he can go out to other broker and try to find some shares to deliver. Or if all else fail, your broker will contact you indicating that you have to buy the share back and indicating what is called a bought out. So that is the basic concept of short selling.